Okay, so basically this is our sheet for Seminar 2 for corporate finance. So how many questions? There's 6 questions. And the first question is pretty much just a bunch of definitions which you'll probably have to Google, but it's pretty easy to find. It's not really that difficult. Question 2 is earnings per share. So you've got profits after interest and tax, and you've got the amount of shares that have been issued by the company. And then B is about diluted earnings per share. So basically, they've just made some changes. Question 3 is pretty chill as well. It's just a bunch of shares, and you've just got 750,000 issued, and you've just got to do some calculations. Question 4 is probably the hardest out of Seminar 2 because it focuses mainly on WACC, weighted average cost of capital. So that's like a much harder formula to find. But if you look at question 2, basically they're just telling you what is the earnings per share, and they've told you that the company's profits after interest and tax are 20 million, and they've got 100 million shares in issue. And the EPS formula is your net profit divided by number of shares. So for question 2, basically they've told us that our net profit is 20 million and there's 100 million shares in issue. So 20 million, 100 million shares issued, EPS equals, calculator, 20 divided by 100 equals 0.2. So equals 0.2, which is basically 20 pence per share EPS. And then we've got the second section, which is basically focusing on diluted earnings per share, assume that the company pays no tax. So we have 60 million. Companies raised 60 million through a 10% convertible bond, and the conversion rate is 1 share for every £1.50. So the main change here is 60 million for a 10% convertible bond, and the EPS stays the same. So from section A is basically the same amount of information, but the only thing that we've increased is, because we have 60 million on a 10% convertible bond, 60 million in a 10% convertible bond, because 10% of the 60 million can be converted, it means that we have 6 million extra that has been converted. So now our net profit is 20 million that we had in section A plus the 6 million divided by 100 million that we had initially plus, and then we've got to work out what this unknown is. And they tell us extra information. They tell us that, what do they say? The conversion rate is 1 share for every £1.50. So 1 share for every 150, and they've given us 60 million through the 10% convertible bond. So 60 divided by £1.50 equals 40. Equals 40, so that means our number of shares is increased from 100 to 140. So our diluted earnings per share equals 20 plus 6 over 100 plus 40, 26 over 140 equals 26 divided by 140 is 0.186. So 0.186, 18.6 pence for section B. So initially we had 20 pence for earnings per share, and now it's dropped to 18.6. Obviously it's been diluted because of the 10% convertible bond. Pretty simple question. Okay. And then question 3 is about Bradshaw PLC. They wanted to issue 750 new shares by tender offer, and they've got 4 options. So you've got 60,500 at 234 pence, and you've got 281,350 at, how much is that? 218 pence. Third option is 408,150 at 201 pence, and the fourth is 503,000 at 190 pence. And they've basically told us that they want to issue 750,000 new shares. So the way you want to do this is essentially you want to start with the highest price and then sort of work down, because the person that's got the highest price is willing to pay the amount less, whereas the guy with the lowest wouldn't be willing to pay the higher amount. So someone that's paying 190 per share wouldn't be willing to pay 234 per share because it's out of the limit. And we've got 750 new shares. So if we work down and we say this guy, so we'll let section A be taken, section B and section C, add up the number of shares and see how much it is, just to be sure. So 60,500 plus 281, 350 and 408, 150 equals 750. So that's sort of a cheat. It's basically know that you've done it correctly, because they've told us that they're looking for 750,000 new shares. And if you just do option A, B, and C equals 750,000, so you know that you definitely want this, this, and this, these three options. And then the lowest price is 201 pence. So these two would be willing to pay 201 pence, so 750. So the answer is essentially 750,000 shares at 201 pence per share. And that is mainly because this guy here would be willing to pay, these two up here would basically be willing to drop their price to pay 201 pence per share, obviously if they're willing to pay 234 and if they're willing to pay 218. So, and then the cheat is you just add up until you get to 750, and that's where you stop. So these guys will be willing to pay the lowest amount of 201, and that is basically question 3. Done.